Hello viewers, this is Dr. Alok Chajed and you are on Already Late, your favorite channel for simplified learning of personal finance, investing and economy. When you hear the word dynamic, what comes to your mind? Changing, adapting, being busy? These could be a few words to describe dynamic. In mutual funds too, we have a category of debt fund known as dynamic debt fund. As the name suggests, this fund offers a lot of flexibility to the fund manager to change and adapt his investment style according to the market behavior. This should make investing in dynamic funds a good decision because the fund manager does not have any restrictions at all. Unfortunately, there are many reasons why you should not invest in a dynamic debt fund, and I am sure that by the end of this video, you would have understood the same. To brush up your concept about debt investing, let me remind you that investing in debentures carry two major risks. Interest rate risk, which is the risk of change in market value of debentures due to a change in interest rates, and credit risk, which is the risk of default on repayments by the issuer of debenture. A dynamic fund has complete flexibility when it comes to selection of debentures to invest. The fund manager can invest in government securities, corporate securities of any credit rating, debentures with shorter maturity, longer maturity, and he can keep moving around because the fund, remember, is dynamic in nature. Now that we have understood the choices that a fund manager has while managing dynamic funds, let us move to some facts and figures. In this video, I have used data of 7 dynamic bond funds to put across a few points. Let us first start with the most common thing that you check while investing in mutual funds, the past returns. The table that you see on your screen now gives you the returns of these 7 funds over the past 1 year, 3 years and 5 years as on 30th June 2020. You see that most funds have done well and a couple of them have lower returns. Nothing strange here because some funds have not performed while others have generally performed well. Now, if I add similar data for the past 1 year, 3 years and 5-year returns as on 30th June 2021, you will see something very interesting. Look at this table. First observation is that returns over the last 1 year have gone down considerably. This was the case across debt funds, not just dynamic funds, because of the lower interest rates post the pandemic. But you will see that not every fund has behaved similarly. DSP Strategic Bond Fund has gone from giving highest returns to the lowest returns. Now imagine as an investor, if you had invested in DSP or for that matter IDFC or SBI Dynamic Funds, looking at the returns 1 year back, what would your state of mind be today? This is the first reason why you should not invest in dynamic bond funds. The returns can be highly fluctuating and unpredictable. You might be wondering what caused this large fluctuation in the returns. The reason for a fluctuating return is also the same flexibility which the fund manager has to build his portfolio. Let me explain this with some more data. The table that you see on your screen now gives you a snapshot of the portfolio composition of these 7 funds. You see that the composition is very different. While Nippon and DSP have invested largely in government securities, Aditya Birla has concentrated on corporate debt. IDFC is holding a lot of cash and equivalents in the form of TREPs, which is short for tri-party repos. A comparison with the portfolio exactly a year ago reveals that along with Nippon, DSP, IDFC and SBI also held a lot of government securities, while HDFC had more exposure to corporate debt. The point which you need to understand and remember is that the portfolios can change drastically over a period of time. Even if you had studied the portfolio before investing, it is highly unlikely that the fund manager will follow a similar style over the next few years. While we are looking at portfolios, let me take you one step further and show the breakup of the securities in terms of their credit rating. The table that you see now shows the portfolio breakup as on 30th June 2020 and 30th June 2021. Do you see that Aditya Birla and ICICI Prudential funds have larger exposure to AA and below rated securities? Now, what does this mean? This means that these two portfolios are riskier as compared to others who have no exposure to these AA or below rated securities. The bottom line is that funds within the same dynamic fund category may be very different from each other, making it extremely difficult for anyone to understand and invest in them. While we are discussing the portfolios of dynamic funds, let me share another interesting bit of information. Let us first look at the number of securities that these funds hold in their portfolio. A quick look at the table on your screen now will tell you that the portfolio can be extremely concentrated, like in the case of IDFC, DSP, and SBI funds, or it can be extremely diversified, like Aditya Birla, ICICI Prudential, and Nippon. This wide difference again reinforces that funds within the dynamic category will vary drastically at any given point of time. After looking at past returns, credit risk, and portfolio concentration, let us now look at one final set of data which deals with interest rate risk. The table on your screen shows the modified duration of the 7 funds. We know that higher the modified duration of a fund, higher would be the sensitivity of the returns of that fund to any change in interest rate. So again, the difference is very clear. You see, you have funds with extremely short modified duration, which makes them less volatile to any change in interest rate. And we also have funds with high modified duration, which makes them more volatile, more sensitive to any change in interest rate. Once again, the point is very clear. Funds within the same dynamic fund category, but they differ largely among each other. Now, before I summarize and conclude, I want to remind you that do not forget to like the video, subscribe to my channel for quick and relevant updates. Just to summarize all the points in one sentence, if I were to just put everything in one sentence, funds within the dynamic fund category vary highly in the past returns, credit risk, portfolio concentration, and interest rate risk. So if you have to invest in dynamic bond funds, you will have to look at all these 4 parameters and see which fund suits your risk profile. Let's say you are able to do all of this very quickly and invest in a fund which matches your risk profile at the moment. What are the chances that the fund manager will continue to follow the same style? There's absolutely no chance. This means that you have to keep checking all these parameters regularly, and you may have to change the fund if the management style does not match your risk profile in the future. This continuous effort is definitely not worth, because there is no distinct benefit that you will derive by investing in a dynamic fund. You are better off in other debt funds like short term, ultra short term, and floating rate funds. If you have any questions on dynamic funds, dynamic debt funds, or if you want to know about investing in any other funds, debt or equity, please feel free to drop a comment and I will be extremely happy to help. Thank you. Happy learning.